Welcome back to the ProTicker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today, we're doing another deep dive, really cutting through the noise of recent headlines, market reports, trying to pull out the key insights for you. We've got a pretty packed agenda. Global trade tensions, big shifts in tech, even some surprising details on U.S. domestic policy. Our goal really is just to help you understand what's actually driving the markets right now. Okay, so let's unpack this. It's a complex web, for sure. We'll be looking at different analyses to get a clearer picture. You'll hear about the AI talent wars, shifts in import strategies, lots to cover. So let's just jump right in. We really have to start with global trade, specifically the U.S. tariff situation. That's been making some serious waves.
Absolutely. It's front and center.
So President Trump announced these new steep tariffs. 14 trading partners, right?
That's correct. Raised between 25% and 40%.
And they're set to kick in August 1st now. I thought it was earlier.
It was. They extended the deadline from July 9th. Gives a bit more breathing room, perhaps.
And the countries, I mean, it's a diverse list. Japan, South Korea, Malaysia, even places like Kazakhstan, South Africa, Serbia.
A very broad sweep, definitely.
What's interesting, though, is how differently they're reacting.
Yeah, the reactions are quite telling.
Japan's PM called them truly regrettable, but, said they'll keep talking.
Right. Diplomacy's still on the table there.
South Korea seems to be speeding up talks, wanting to resolve uncertainty quickly. Malaysia's talking about engagement, looking for a, quote, balanced deal.
And South Africa even pushed back on the data, saying that 30% tariff figure isn't accurate.
Exactly. Meanwhile, the UN Trade Agency is worried this delay just prolongs the uncertainty. A dual shock for developing nations, they called it.
More uncertainty isn't usually good news.
So, with all these different responses, how have the markets actually processed this?
That's the key question. And it's been fascinating to watch. Because while U.S. markets, all the major indexes, had their worst day in nearly a month right after the announcement.
Right, I saw that drop.
Asia-Pacific markets were, pretty mixed. Surprisingly so.
Mixed? How so?
Japan's Nikkei's 225, South Korea's Kospi, they actually rose.
Really? Why the difference? That seems counterintuitive.
Well, the thinking seems to be cautious optimism over there, the extended deadline. Maybe it means more time for negotiation, a chance to get a better deal, rather than just getting hit with these high rates immediately.
Ah, okay. So less of a definite hit, more of a wait and see.
Potentially. Some analyst, Jim Cramer, for instance, suggested maybe these aren't even And that's not just investors like you and me. Central banks globally are buying more gold, partly hedging against this trade stuff, partly looking for alternatives to the U.S. dollar.
Which brings us to the dollar itself.
Right. Which tumbled, 10.7% in the first half of the year? Worst performance since 1973, I read.
Wow. Since 73.
Now look, a weaker dollar can help U.S. exports, make them cheaper.
Yeah.
But it also sparks these bigger questions about, American exceptionalism, dollar dominance. Are we seeing a shift?
And treasury yields.
They've been rising. Seems the focus there is on these new tariff rates and inflation concerns creeping in. So you see, it's all connected. Trade policy shifts. And suddenly, money moves, assumptions get challenged. It's the complex web.
Definitely a lot of moving parts. Okay, let's shift gears a bit. Moving into the tech world, the battle for AI talent seems incredibly intense right now. What's caught your eye there?
Oh, it's fierce. Absolutely fierce. And the biggest piece of news recently, I think, is this major move from Apple.
What happened?
Their top exec for AI models, Ruming Pang, he's left, gone to Meta.
To Meta. Wow. Pang was leading their foundation models team, right? The core stuff for Apple Intelligence Theory.
Exactly. A distinguished engineer running a 100-person team. This is a significant departure. It really throws a spotlight on how cutthroat this AI space is.
And Meta's really pushing hard in AI.
Oh, absolutely. Zuckerberg's made it their #1 priority. They're apparently on a massive hiring spree for this superintelligence group.
Offering huge packages, I heard.
Reports say tens of millions of dollars per year to lure top people from places like Scale AI, OpenAI, and Anthropic.
Tens of millions per year.
That's the word. And Zuckerberg himself is reportedly recruiting, wining, and dining potential hires.
Man.
So yeah, this departure from Apple, apparently that foundation models team was already facing of internal questions. This is the biggest AI exit they've had in years.
And the worry is it could trigger more exits if Meta's paying that much more.
Yeah, it's the concern. It just highlights the immense pressure. You need these top experts, but keeping them is getting incredibly expensive and difficult.
And this talent fight, it doesn't just impact software, does it? It sends ripples through the hardware side, too.
Exactly right. It's all connected. Take Samsung Electronics, for example.
What's happening with them?
They're forecasting a huge drop in second quarter profits, like 56% down,
56%. Why?
largely because they're having trouble capturing demand from NVIDIA, for those high-powered AI chips everyone wants.
Ah, the NVIDIA effect.
Precisely. It shows how interconnected the whole tech ecosystem is. Even a giant like Samsung feels the pinch when demand shifts for another company's product. It's a stark reminder, really. No one's immune.
But it's not all struggle for established players, is it? We've been hearing a lot about IBM's comeback.
That's a great pivot, yes. IBM's is a fascinating story right now, a real resurgence under CEO Arvind Krishna.
The stock's done incredibly well since he took over in 2020.
Dramatically well. Since April 2020, IBM shares are up, on a total return basis, something like 264%. Compare that to the S&P 500 at maybe 173.5% over the same period.
That's huge outperformance.
It is. And maybe more telling, their price-to-earnings multiple. It's jumped from around 10x to 27x.
So investors see it as a growth story now, not just a value play.
Exactly. That's a massive shift in perception. Analysts are pointing to their infrastructure software, their embrace of cloud tech, the Red Hat acquisition. It shows strong leadership and smart strategic moves can revitalize a legacy giant.
A real turnaround story.
It really is. A blueprint, maybe, for other established companies. Kind of challenges that idea that only startups can drive innovation. Of course, you contrast that with, say, Nissan. Their shares plunged after they announced plans to sell billions in bonds. Different company, different pressures.
Right. And one more on the tech tail side. Shein, the fast fashion giant, they filed for an IPO in Hong Kong. What's the story there?
Yeah, confidentially filed in Hong Kong. The reporting suggests it's actually a strategic play.
How so?
To put pressure on UK regulators. They want to list in London, but apparently that process is stalled. Disagreements over risk disclosures.
Specifically about their supply chain, Shein.
That seems to be a major sticking point. Plus, they faced investigations in the EU over consumer protection laws, and then there's the whole U.S. de minimis loophole closure.
Ah, yes, the de minimis rule change. That allowed cheap stuff in duty-free, right? Closing it hurts fast fashion.
Exactly. So for you, the listener, closing that loophole makes those cheap, direct ship imports more expensive. So the Shein saga really highlights the tightrope global companies walk. Regulatory hurdles, ethical questions, especially when trying to list publicly in multiple places. It's a complicated dance.
Definitely sounds like it. Okay, let's pivot again. Let's talk emerging markets and maybe some critical supply chains. India seems to be making some interesting strategic moves on energy imports.
Yes, quite strategic. They're planning to source about 10% of their cooking gas LPG imports from the U.S. starting in 2026.
10% from the U.S. Isn't that unusual? Freight costs and all that?
Historically, yes. They rarely bought U.S. LPG because it was more expensive to ship. But things have changed.
How?
China put retaliatory tariffs on U.S. propane. That kind of squeezed U.S. supply, making it available, maybe more attractively priced, for other buyers, like India.
Ah, geopolitical shifts creating new trade flows.
Exactly. And for India, it's part of a bigger plan to narrow their trade deficit with Washington. They're aiming to boost U.S. energy buys significantly, maybe $10 billion to $25 billion more soon.
So the key takeaway is diversification.
Absolutely. It's a conscious move away from relying too heavily on Middle Eastern LPG suppliers. Reduces geopolitical risk, helps secure energy for their growing demand. LPG use is growing 5–6% a year there.
Yeah.
So getting reliable alternatives like U.S. is, well, pretty crucial.
Makes sense. And staying in India, there's this new asset management venture, Jio BlackRock. They have big plans.
Oh, yeah. This could be really disruptive. It's a joint venture planning to launch nearly a dozen equity and debt funds by year-end.
And they're targeting small investors.
Very small. Investments as low as 500 rupees, which is what, less than $6 US.
Wow. And what's their disruptive angle?
Well, think about Jio and Telecom. They came in with aggressive pricing, used their massive network, and just blew up the market, right? Became the biggest carrier.
Hey, they really shook things up.
They plan to do something similar here. They're going direct only, bypassing the traditional distributor.
To cut costs.
Exactly. Leverage Jio's huge network, 475 million subscribers, and BlackRock's tech platform, Aladdin. By cutting out the middlemen, they think they can slash expense ratios significantly, maybe by 0.5% or more compared to typical active funds.
That's a big saving for investors.
Huge. And while BlackRock's known globally for passive funds, they're planning a mix in India. Active funds still dominate there, but passive is growing fast.
Hmm.
So this could genuinely reshape India's fund industry, make investing much more accessible, more affordable for millions. It's a potential game changer for financial inclusion.
Really interesting. Okay, finally in this segment, let's touch on a supply chain vulnerability that maybe doesn't get enough attention. Copper.
Ah, yes. Copper. Absolutely critical and often overlooked.
It's essential for chips, right? But we don't usually think about its supply chain being at risk.
We don't, but maybe we should. There's a new PwC report out,
Hmm?
and it's pretty sobering.
What is it?
It estimates that by 2035, almost a third, 32% of global semiconductor production could face copper supply disruptions linked to climate change.
A third. That's huge.
And a fourfold increase from now.
That's what they're projecting. You look at Chile, the world's biggest copper producer, they're already dealing with serious water shortages slowing down production.
And copper is irreplaceable in chips, basically.
For now, yes. Nothing else really matches its price and performance for those billions of tiny wires inside every chip.
So this raises a big question, right, for you listening. Just how resilient are our high-tech industries to these climate risks?
It's a critical question. The report warns that unless we see major innovation in materials or find ways to secure water supplies in these mining regions, the risk just keeps growing. By 2050, they warn, maybe half of every country's copper supply could be at risk.
Half. Wow.
Yeah.
Are they doing anything? Chile, Peru? They're building desalination plants, trying to address the water issue. But that's expensive, energy intensive, not a magic bullet. It really highlights this fundamental challenge. Our most advanced tech relies on finite resources and a stable environment. It's a risk factor we can't ignore.
A hidden vulnerability, indeed. Okay, let's bring our focus back home to the U.S. There's been a lot of talk about President Trump's One Big, Beautiful Bill Act, sweeping changes, affecting workers. Can you walk us through some key parts?
Sure, it's definitely got a lot in it. For instance, there's a new deduction for tips. Qualified tips, up to $25,000 a year, deductible from taxable income.
Okay, for tipped workers.
Right. Retroactive to the 2025 tax season, but there are income caps. And similarly, there's a deduction for overtime pay. Up to $12,500 for overtime hours worked beyond 40 per week, again, with income thresholds.
And these expire.
Both are set to expire at the end of 2028, so temporary relief.
What else is in there?
Well, things like extending federal Pell Grants to students in certain workforce training programs, increasing tax credits for employers who provide childcare, making the tax-free status of employer payments for student loans permanent. A real mix of things.
Sounds like measures aimed at boosting the economy, helping workers. But are there catches? Complexities?
That's always the important question with tax policy, isn't it? And yes, experts are pointing out some nuances.
Like what?
Well, take the tip deduction. How much does it help someone who already wasn't paying federal income tax on their tips? Maybe not much.
Good point.
Or the child care credits for employers. Historically, those have tended to benefit larger companies who have the HR departments to manage the paperwork, not necessarily small businesses. So the impact might not be evenly spread. It's often more complex than the headline suggests.
Nuance is key. And speaking of nuance, there was some confusion about Social Security benefits. An email went around.
Yes. That caused a bit of a stir. An email, apparently from the Social Security Administration itself, claimed the bill eliminates federal income taxes on Social Security benefits for almost 90% of recipients.
Which sounded huge. Is it accurate?
Tax experts say no, that's not accurate, not quite.
Okay, so what does the bill do regarding Social Security taxes?
What it does include is an additional deduction, they're calling it a bonus, of $6,000 for seniors age 65 and over.
A deduction, not an elimination of tax.
Correct. It's a deduction. It reduces the amount of income subject to tax. It doesn't wipe out the tax entirely for most people. It primarily benefits middle-income seniors.
Got it. So it helps, but doesn't eliminate the tax for most.
Exactly. And there's a cost. This deduction is estimated to reduce Social Security tax revenues by about $30 billion a year.
$30 billion a year? What does that do to the trust fund?
It accelerates the projected insolvency date, pushes it forward to late 2032, according to estimates. So while there's a benefit for some seniors now, it potentially creates a bigger problem down the road for the system's finances. The devil, as they say, is often in the deductions and the long-term impacts.
Certainly sounds like it did cause some double takes with that email. Okay, so let's try and tie all this back to the overall market sentiment. You mentioned earlier the market looks very overbought by some metrics, potential vulnerability, especially around trade.
Right, using indicators like the RSI, the Relative Strength Index. When it gets above 70, that often signals things might be a bit stretched, maybe due for a pullback.
But on the other hand, we're hearing bullish calls too, right? Especially in AI, maybe biotech.
Absolutely. There's a strong counter-narrative. You've got people like Steve Eisman, famous from The Big Short, saying the AI trade is just getting started. He's bullish on the NVIDIAs, sure, but also the energy companies powering all that AI infrastructure.
So the picks and shovels of the AI gold rush.
Kind of, yeah. And then you're seeing this biotech breakout people are talking about, analysts getting more positive on major pharma stocks.
So are these just isolated bright spots? Or do they suggest maybe there's underlying strength that can ride out these macro worries?
That's the million-dollar question for investors, isn't it? It seems we have these broad concerns, trade, inflation, policy uncertainty, creating volatility. But at the same time, there are specific sectors, specific technologies, specific companies where investors still see really strong long-term growth potential.
So it's not a uniform picture at all.
Not at all. It seems like a market of contrasts right now. You've got these powerful cross-currents. It really demands a selective approach, I think. You can't just buy the whole market and assume it'll go up. You need to dig deeper.
Makes sense. So wrapping this up, what does this all mean for you, our listener, trying to navigate today's financial landscape? We've covered a lot really quickly. Global trade tensions, rocking currencies and markets. An intense AI talent war redefining tech giants. Critical supply chains like copper facing hidden risks. And domestic policies with complex, really nuanced effects on wallets and entitlement programs.
Yeah, a whirlwind tour.
I think the key takeaway really is just how interconnected everything is. Politics, technology, basic economics, they all weave together. A decision over here can send ripples everywhere, creating challenges, yes, but also maybe unexpected opportunities.
That interconnectedness is vital to grasp.
It's just a constant reminder, isn't it? You need to understand how these forces play off each other to be truly well-informed. This whole deep dive really underscores how fast narratives can change, how important it is to look beyond the headlines, beyond the surface noise. We went from the big macro picture tariffs, the dollar, right down to the nitty-gritty of company turnarounds like IBM and specific policy details. What stands out most to you about just how quickly these financial tides can turn? That seems to be the theme today.
It really does. The speed of change and the complexity, it requires constant vigilance.
Something to mull on, definitely, as you consider the market's ever-evolving story. That's all the time we have for this deep dive.
Thanks for tuning in. We'll see you all tomorrow morning with new headlines from major financial magazines.